What's up guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So this is going to be your mortgage rate update. Also, the Fed fund rate increased again by 75 basis points. So don't be surprised if we actually see 8%. Have we seen 8%? Yeah, back in 2000 we saw 8%. Now why did we see 8%? Because of that damn .com bubble thing. But let's get on with the mortgage rate update. Also, I'm gonna go ahead and give you detail of exactly the difference between buying power now versus the 6% we're at, versus if we were at 8%, versus if we were at the 2.5% before on a national average income. But as far as right now is, we're gonna be pricing out 10 different mortgage products as of 9/22/2022. Now everything went up, of course, because the Fed fund rate increased. Now, if you don't know what a fund rate is, it's the amount that a bank charges another bank in order for them to borrow. So majority of banks, including ourselves, insuring body or whoever it is, we sell mortgages to like a Fannie Mae or Freddie Mac, and then they'll go ahead and bundle it up and then they'll sell it to the secondary market. Now the Fed fund rate, typically banks will go to a centralized bank, and then the centralized bank will go ahead and set how much they are doing, and that's what the Fed fund rate is. But let's get on with the mortgage rate update. 30-year fix will be sitting at 5.76%. 15-year fix will be sitting at 4.96%. 30-year high balance will be sitting at 5.84%. DSCR loan, which is a debt service covered ratio loan. This is a loan product that is mainly to go ahead and qualify your loan product from the rental income coming in versus the debt, which is the principal, interest, tax, insurance going out. That'll be sitting at 8.50%. Bank statement loan, which is another non-qualified, non-agency loan, non-qualified mortgage, non-agency loan, that'll be sitting at 8.50%. A 30-year fix will be sitting at 5.41%. 7/6 adjustable rate mortgage will be sitting at 6.01%. That is going to be adjusted every 6 months after the 7 years is over. So 7/6. The first is how long it stays interest only. Then after that, it's going to go ahead and adjust according to the rate in the market every 6 months after that. That'll be of course 6.01%. USDA loan, that is going to be sitting at 5.32%. That is one of those zero down payment programs. VA 30-year fix, another zero down payment program for veterans, that are sitting at 5.42%, and hard money fix and flip is sitting at 9.75%. If you see a distressed property and you want to go ahead and fix it up, doll it up, jazz it up, whatever you want to do, turn it and then sell it for a profit, that loan product is actually going to be 85% loan to value, which means that you only need to bring 15% to the table, and then we'll go ahead and cover 100% of the total rehab costs in order for you to fix that property, and then we'll sell it. As long as the numbers work out, you're good to go. And now for that shameless plug, for up to 50% commission rebate on purchasing your next property, 0% listing on selling your current property or any of the mortgaging products and some. If you have any questions about anything, link in the description below. Let me help you. Let me beat your big bank. But as far as buying power is concerned, this is why the real estate market right now is going to slowly get onto the dwindling side. They're slowly starting to decline. Now let's say we took the national average, right? The national average on income. Now the national average income is between 55 and 60,000, and then so for this scenario, we went ahead and did a $250,000 purchase price. Doesn't exist in California, that's for damn sure. Definitely does not exist here. I mean, it could, like way out in the boonies, but with California, LA area, San Francisco Bay Area, Orange County, San Diego area, medium household income, or not income, but prices are teetering around the 1 million price point. But for the sake of argument, if you wanted to go ahead and adjust the price to where you're at, link in the description below, www.aldenmortgage.org. That's my personal website. We have calculators on there. You could go ahead and put the purchase price. You could see how much money you could afford. You could go ahead and use a calculator that's put your income in, your total liabilities, all that good jazz. You could kind of go ahead and see exactly how much money you could afford. So just to give you a heads up, the ratios that you want to go ahead and stay around, if you're going to go with an FHA, the FHA guidelines states that your debt to income ratio on the back end, which includes your total liabilities as far as your like credit cards, student loans and all that stuff, combined with your housing, the back end ratio is sitting at 56.99%. So just always keep that in mind. We have that set up to the conventional side, but you might want to go ahead and look at that one too. But let's go ahead and pop this up. I'm going to give you this little screen share thing. So for $250,000, $5,000 a month income, the total buying power is going to be $360,200. Now, as of today, we're averaging about 6%. 6%, that'll put you at $289,000, which is a $71,000 decrease in buying power. And if we do go up to the 8% mark, that is going to be $110,900 decrease in buying power, which is going to be at $249,300. Now that's why the total price of real estate is going to start dwindling down, because it's not going to happen right now, because we don't have anything to crash it unless the stock market completely crashes and goes to absolute shit. That's the only way that we're going to end up getting hit, because let's say, for instance, if the stock market does go take a dump, that means that the valuation that companies have will dwindle. You guys all heard it across the news, and if you haven't, like just like that, overnight, Jeff Bezos, which is one of the richest men, I think maybe like top 3 richest men in the world, Elon Musk, Mark Zuckerberg went, I think he dropped like 20 spots as richest man in the world. Now he's like 22, because how much the interest fund rate impacts the whole entire, all companies as a whole. For the first time, now this is what inflation is doing, and this is what they're trying to counter. So for the first time ever in a long time, I think it was back in April when it finally surpassed, the euro was always the benchmark, right? Euro was always outnumbering the dollar as far as value goes. But now, for every $100 or 100 euros, that equates to $98.41. So now the American dollar is actually worth more than the euro. That's what they're trying to do. Now, have we seen 8% in mortgages before? Well, absolutely, yeah, we did. We saw it back in 2000 and in the year 2000. So back in 98 and 99, interest rates were roughly between the high 6s and then the mid 7s. And then after that whole dot-com bubble, you remember that Y2K where everybody was losing their mind. They were buying canned goods and a bunch of water and everything like that. Just like these idiots that were buying toilet paper. Why the hell were people buying so much toilet paper at the beginning of this pandemic thing? It blows my mind. Like, people died because of freaking toilet paper. Whatever, that's for another video. But 2000, when the dot-com bubble hit and everybody was scared out of their mind, interest rates went all the way up to 8.15. Now, I don't have historical values on my personal site for this, so I went directly to Freddie Mac. Freddie Mac is one of the insuring bodies on mortgages. They went to 8.15, so then they had something that was called quantitative easing, right? They were trying to ease the economy. They were trying to, like, you know, bring buying power back to the real estate market. Then it dropped down to 7.3. Then in 2000, it went down to 6.49. Now, as you went along, you were in 2003 to 2004, 2005. Like, you see how this real estate thing takes such a long time for it to go out and adjust. Well, then they started easing stuff around, and they were giving us as much as we wanted, but we were still somewhere in around the 6s and 7s, right? The lowest point we hit was 5.70% in 2005. But we were hitting right before the whole entire housing bubble, the housing crisis went. We were around 6.2 to at the end of September to 6.38, and then right after, what happened when the whole real estate market went to shit? 2008, the housing bubble hit. That's when they were like, uh-oh, we jacked up, we messed up. Fed fund rate decreased again like it did during the pandemic. They're like, we're not going to charge people for credit because everything went to bed. We need to go ahead and stimulate the economy so people go ahead and start buying again, which then it dropped down to the 5s, then it went to the 4s, then it went in 2012, it went to the 3s. And then as of recent, and 2 years ago, we were down at 2.5%. So do not be surprised if we actually see it 8. Now, there is more Fed fund rates coming up. The one that we had yesterday was at 75 basis points. So this has been a really big jumps every single time. But I've said this a million times before. I don't understand for the life of me why you just don't hit us hard once and get it over with. Back in the day, and everybody starts talking about it, and I know I talk about this all the time because you have to look at history in order for you to understand the present. Now, back in the day, post Vietnam War, we had the Volcker shock. Paul Volcker, he went ahead and said, you know what, inflation is getting out of control. We need to hit him really, really hard out the gate. And he fixed it. He was hated. Everybody hated this guy at that point, but now everybody's like, God dang, that guy made a lot of sense. He actually fixed things and he knew exactly what he was doing. But That's going to be your mortgage rate update. So up to 50% commission rebate, 0% listing on selling your current home or any mortgaging assistance. Link in the description below. Till next video, guys, I really appreciate you watching. Like, subscribe, comment, all that other good pajazz. Till next video, peace.
Let's do a 3.2.
Don't know when the plans swing it. If you got a glass, fill it. 'Cause I need it. Money is a